Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be taking a look at Target stock, which is getting crushed today after they reported earnings that disappointed estimates. Stock is down about 20% today. Let's see what it is year to date. Where do we start out the year at? Yeah, it's even down year to date now, too. So let's do a little valuation work on this and see what's happening with Target. So I wanted to show you that 22% decline there because it's not going to show up on fast graphs until later tonight after the market closes. But the stock is indeed trading down around 123 or so. So as always, this is not individual investing advice. This is just how I analyze stocks. I last covered Target on the channel back in January of this year, so a little less than a year ago. And at that time, let's take a look. It had just kind of bounced off the bottom here. Let's shrink this down. Somewhere at the very beginning of January in here, I did a video. And what's interesting is my buy price for the stock is not going to change. And I went and looked at analyst estimates for earnings this year, and I want to say they were like 830 something, which is basically the range that they just adjusted down. I mean, we'll see what happens next quarter, but for the most part, the earnings expectations are now the same as they were at the beginning of the year for this year. But the stock is trading lower. I want to say it was about 138 when I made my last video, and now it's down to 123, even though earnings are back to where they were kind of expected to be. Although I'd say that maybe there's some more uncertainty with those earnings. So the market basically, and maybe even Target, got a little optimistic about growth this year. And it turns out that growth is almost certainly going to be equal to or less than last year. I think the midpoint is definitely less, but if they do better than expected, it could come out a little bit more. So this stock is down. Let's see what I say. We were at 120. So it's down over 50% now. Maybe I can do the equivalent on this old. Yeah, it's not down to where it was before. So it's seen these levels. Yeah, it's down about right here. Yeah, over 50% off the high. And I'm sure there's been people that have been kind of buying after this dip, and it just wasn't cheap enough, right? And so we're starting to see why it wasn't cheap enough, because one small disappointment and all of a sudden you're down 20%, and probably justifiably down 20% if earnings they're going to make a lower low here. Let's see, earnings were at 639 back in 2020. Let me just do a quick calculation here. I didn't do this. Sometimes I do this in my spreadsheet, but I just want to see if what we've had, maybe like 25% inflation since then. So if we just take that, if we just add inflation to this pre-pandemic number, we're looking at like $8 per share in earnings. And so if they come in at like 830 or 860, something like that, they're just making a little bit more than like the inflation rate over the past 1, 2, 3, 4, 5 years. So that's not much growth. It basically means that they're growing really, really slow once we kind of ignore this pandemic boom and then the pandemic bust and all that. That's what this earnings blip here is. So real growth, it looks like it's going to be pretty slow. Now, one argument could be that, hey, the economy's weakening, and so that could be explaining their problems. Walmart, people love their report, even though they only grew revenues like 5% or something, with 3% inflation. I mean, so they aren't really growing that much more than Target on a per share basis, but they're growing like a little bit more. So that's the difference between the 20% decline and whatever they're going to have, like a 12 PE and like a 40 PE for Walmart. So it's kind of ridiculous in that sense. But if we just take Target by itself here and look at the earnings, let me see I'll have to look I just adjusted the expectation this morning. So I went to the midpoint. I think it was like $8.30 to $8.90, and I went $8.60 assumption for earnings this year, just to the end of the year. And then I assume about 5% earnings growth, which is what I had back in January. The revenues have, their 3-year revenue number has declined a little bit, but that's expected because we're kind of getting to the point here where if you go back 1, 2, 3 years, that was basically the peak of the pandemic boom. So I wouldn't hold that 3-year revenue decline. I didn't update it for this brand new earnings report. It's probably going to be negative once I do that. But I wouldn't hold that totally against them because that's just coming off of a boom period, right? It doesn't necessarily mean that they're in some kind of secular decline yet. If we go another year and it's still negative, then you need to start getting a little bit more worried about it. So I would kind of ignore this for now. My 5% growth looks to be pretty decently on target, maybe a little strong. I looked at my last video and analysts were thinking it was going to be 9% this year. Now this is based on history with some adjustments that I made. And I just think it's more realistic. Now we see that it absolutely is more realistic. They're not going to grow. They're going to shrink this year. They aren't going to grow anywhere close to 9% earnings. So this, for me, just kind of stays the same. I'm not going to get overly negative or overly positive like analysts did earlier this year. It's just kind of steady as she goes. And so when I do that, even with the price that's at now, 123, I get this 10-year CAGR of 5.48%, which is about what the market's pricing everything at. So you can totally see what you can explain the 20% decline, because this has the 20% decline. It has the earnings adjustment from this last report. And when you do the math on that, it comes out to about 5.5% 10-year earnings CAGR. So this is about what you would expect to earn from the earnings if you own the business, and they grow at 5% from here. So this all looks pretty normal. And then the question is, well, at what price do you want to buy the stock? And so we're getting to the point now where this year's current earnings growth decline, can't really be explained by a boom bust period. And so that excuse is kind of gone for this year. So we need to really get in and say, okay, now is this a wider economic decline, or is it target specific? It might be like a combination of both, but because we will see. Just because Walmart was a little bit better, I mean, doesn't mean, I own Dollar General stock, it wasn't better. There's several other retailers that weren't good, like weren't that good. So it could be the beginning of a bigger economic decline and like economy-wide decline, like on consumer spending and things like that. But it's just hitting these businesses first. So that's a possibility too. Probably the most likely, but there could be execution issues into a Target. I've seen this stock drop 20% at least 2 or 3 times in the past few years. So it just does this sometimes. Now, when to buy it? Provided earnings growth doesn't get worse. Like if we go next year and the economy ends up being fine and they're not growing earnings again, that's a more fundamental problem that you might want to just not buy the stock at all. But if we are having a slowdown of some sort, this $77.74, so $77.74 buy price, this is the same one I had at the beginning of the year, and it's the same one that I have now. If we think this is a temporary economy thing, slowdown, then if you buy at this price, you're going to get a good margin of safety. And even if they don't grow super fast, you'll be able to make some good money on the recovery. It kind of assumes a recovery. Conveniently, that's almost the exact same price right now as if you do the math on 5% growth and $8.60 in earnings over 10 years. That comes out to a $75 buy price. It's basically the same thing. Now, if those earnings get worse next year and it's because there's a recession, then this kind of normal number here will it'll get lower because things will get worse and worse. So this will keep getting lower, but this recession buy price, it just stays the same because it's built in that you're assuming that there'll be a recovery after a couple of years. This was 50%. The stock would have had to fall 50% the last time I did this update almost, and now it only needs to fall 36%. People will always tell me like I'm crazy and the prices will never hit. Well, they might not, right, on this particular stock. But if you want to make money, like good money, then you have to buy these type of slow growth. This is a slow growth business. You have to buy them cheap if you want to make good money. So I'm just trying to see if I can find some evidence of that. Okay, let's go back to the last cycle so I can make my point. So that recession buy price was based on the 2008 decline. You actually also had a similar decline back here in 2017. But let's use this one, okay? Let's say you bought at a 25 PE. Things were going, well, actually, yeah, we can even go like up here to like a 20 PE when it was near the top of the cycle. That's not super expensive. They were growing 18%, 31%, 18% going into that. I mean, it's less than a PEG ratio of 1 on the near term, on the 3 years leading up to that, right? That valuation compared to where stocks are trading now is cheap. So let's just say you bought there and you held through this period until kind of this next kind of peak here, which is in 2013. So how many years? 1, 2, 3, 4, 5. Let's just call it like 6 years. You hold 6 years. You only would have made 3% a year on that investment. Now let's say you bought it when it was cheap. I won't pick like the absolute bottom. Let's just pick it like right there. Okay, that's still, let's see how far away that is from the bottom. That's still 40% from the bottom. I'm just saying you buy it relatively cheap. PE of 13 or something. You do the same, roughly the same period, only you hold for 5 years, 4.5 years, something like that. And now you have almost a 15% CAGR. It's the exact same business. Earnings grew the exact same amount from there. It's only like 1 year difference basically from when you bought it, or a year and a half. But your returns are multiples times better. And that's why you have to buy them cheap. And that's not even buying near the bottom. We didn't have to have the total bottom fall out. We just needed that initial panic to get it at $40 a share, and then you hold for a few years and you can get 15% returns, right? That's what you want. If you pay too much, then this is a pretty mature business with lots of competition. Until we get to the pandemic, well, we had tax cuts in 2018 too, but I mean, until we get to the pandemic, if you bought back here before the Great Recession and you just held, you could hold for almost, that's 10 years and you only get a 4% year return. It's just not very good. Well, you wouldn't have lost money, that's true, but you wouldn't have made very much money either. And then you would have had to sit down through like 60%, a couple 50-60% drawdowns, which is no fun. So, my buy prices are low, but there's a reason that they're low, especially for a mature business like this that's going through kind of a wonky time. Maybe the market will overreact though, and it sends it way down cheap. I mean, it was below, what I have, $77. It was below that in 2019, which wasn't a recession or anything, and it didn't quite get there in 2020. But we'll see what happens. It's just not worth buying when the growth isn't there unless you're getting a good deal. So that's the way that I feel about it. But it's not as crazy overvalued as Walmart still. So, okay, if you found this useful, go ahead and hit the subscribe and like button. I have a free tier on Patreon. I post all these videos too. I also have a $5 tier. If you have requests that aren't in the S&P 500 you want to ask me for. And I have a weekly pick $25 tier on Patreon. So for all the folks that say I never buy anything, every week I will share a stock idea of the best thing that I can find that particular week. All right, I'll see everybody later. Bye.